how to think about investing cash in a portfolio. Is cash worth holding now? Well, I think clearly it has no risk and it has a high return, 5% or more if you get a decent way to invest in cash, and it has no risk. And so that means, yes, probably it is a viable asset class right now, especially given the inverted yield curve and how cash is relatively favorable compared to even historical recent performance of some stocks and bonds. So then there's the question of how much cash. Well, that's a big question mark. Including some in your portfolio seems like a good idea. Having only cash is clearly probably a bad idea for long-term wealth. What's the right amount? What should you do with the rest of your portfolio is unclear when you're thinking about cash as well. So I want to bring some considerations into terms of how do we think about the overall efficiency of how you're investing, how optimal are these choices, and what's the right amount of cash, and what sort of behavioral issues there might be as well. And so just to think about how the other issue is for investing is, well, should you have cash? Should you have stocks? Should you have bonds? Or should you have all of them? And so people have concerns. That is part of what feeds into this narrative of, well, just hold cash and you'll be better off. So are stocks overvalued? I think it's important to remind people that the markets are always forward-looking and that they will discount stocks until the risk premium is positive. So in theory, stocks should always have a positive expected return that is higher than cash. Now, can bonds lose value? Of course, that's true, but bonds now have a positive real return for all maturities, that interest rates are high enough and inflation is low enough for a long time horizons. Bonds make sense and seem to be a viable asset class. There's another notion that you should be timing bonds. And either some people thought they should have done this already. It turned out they were wrong. Other people think that it's imminent, and because bonds will beat cash after rates peak. So that is true, but we don't know when rates will peak. We don't know the future. So I advise people against trying too hard and putting too much effort into timing the markets there, because markets are already coming up with their expectations for you. So how do you invest for this uncertain future? And I think the right answer now and pretty much always is to think about what is the risk and return trade-off, and then how do we optimally diversify for different investment goals. And so that's what we want to do with cash. To go a little deeper into this question of, do you really believe that stocks are okay to invest in right now? I think some people have brought up that, well, with interest rates at 5 or 6% and maybe forward-looking returns for stocks, who knows what they are? Maybe they're less than 5 or 6%. So should I invest in stocks as well as something like cash? And so what I did is I went back as far as there was a Fed funds rate back to 1954 and looked at, well, what's today's Fed funds rate in July of 1954, and what was next year's stock returns for the S&P 500, and continued this for every month until the most recent, a couple months ago. So, and then we could split this into regimes of generally lower interest rates, generally higher interest rates, and interest rates that are roughly what we have now, and see, well, when interest rates, Fed funds rates are roughly what they are now, does that make it a bad time to invest in stocks, or would you be better off holding cash? And we got a somewhat surprising result here. So these are the many observations that are scattered all over the place, and it's hard to tell exactly what they are. So when you summarize it in a table, though, you get a surprisingly high 11.5%, and volatility is a surprisingly lower than historical number. So you might interpret this to say, wow, I should drop everything and go all in on equities. I'm definitely not suggesting that, but what I am suggesting is that there is absolutely no evidence from historical data that when Fed funds rates or interest rates are sort of what they are now, that it's a bad time to invest in stocks. So my conclusion here is stocks are still a perfectly viable asset class based just on the information of historical interest rates. So then what about bonds? I think the most important thing to remind ourselves about bonds, even long-term bonds, is that today's yield for a bond is an excellent predictor of what the realized return for that bond will be over time. And you can certainly visualize this and understand it. If you have a 10-year treasury bond, you hold that to maturity, you know exactly that you're going to get whatever the yield is over the 10 years. Well, the math works out even for a portfolio of bonds, even for an ETF of bonds that is traded all the time. You will see the daily price variations, but if you hold on to it over time, you are very likely to realize something close to today's yield when you hold it for long enough. And this is just the empirical result here, that indeed, when rates are around a certain level, they tend to have realized returns that cluster pretty close to their certain level. And so I highlighted the current range here. This combined with not just the nominal rates, so what inflation is, and the projected inflation, means that real rates are positive 2.5%, something in that range, which is historically high, which is, again, saying that bonds seem like a viable asset class in a portfolio. So if stocks and bonds are viable, then that means that you should have, and cash is also desirable, that means that cash should be considered as part of a portfolio. So a mistake that somebody might make is to think of cash totally separately, and because they like it on its own, and then think about, okay, well, now I need to be extra aggressive with the rest of my portfolio so that I can meet my investment goal. And so I've sort of illustrated this here. So here's what cash looks like from a risk and return perspective. This is just for illustrative purposes. There are no numbers here on purpose, but generally there's a more aggressive portfolio with more risk and more return. And so you will make some combination of just holding cash and having a totally separate portfolio somewhere else. And you might want this to be, say, a moderate risk portfolio for your investment goal. Well, the problem with that is, even if cash is great, and even if this other portfolio is great on its own, it is not the right portfolio for your moderate risk investment goal, and this is inefficient. That means that there is some other portfolio that has less risk and more return, and that if you consider the whole investment at once, then you can do a better job of building a portfolio for your investment goal. So I think that means that there's an answer here where you're taking the whole portfolio and including cash as part of the portfolio. So if you've been following us, this is exactly what we did early in the year, where we said cash is now a viable asset class. Our favorite way to access this is through Treasury floating rate notes, which is no risk, is low duration as anything, and has one among the highest ways of capturing the short-term interest rates. And we included this in a portfolio. And so what I want to show you here is the highlighted red parts show that for a conservative, say 20/80, moderate and aggressive 60/40, 75/25 portfolio, how much cash of this Treasury floating rate notes should actually be allocated to your portfolio. So currently we have in a conservative portfolio about 25% of Treasury floating rate notes and 10% cash in a moderate portfolio, 5% in an aggressive portfolio. And so we think this is the optimal rate right now based on the current yields on cash, as well as the risk and return of all other asset classes. Now, if interest rates go up or down, these answers won't be the same anymore. And so I wanted to show you that we have this covered. This is something that we can well handle through an optimization process. And so just to illustrate this, if the Fed raises rates to 6% or drops them down to 5 or 4.5, what a cash allocation, an optimal cash allocation might look like. If it goes up a little bit, you can have the top line here, 30, 13, and 7 for conservative, moderate, and aggressive. And interestingly, if the Fed drops rates down to 4.5%, cash no longer would be a viable component of a portfolio anymore, or certainly not a very important one anymore. And so that's something to think about. But I think our point here is that not that these are going to be the exact right numbers, because all sorts of other things are going to change in the time it takes for the Fed to change interest rates. But we have thought through a sophisticated optimization process for how to optimally incorporate cash into a portfolio, and we are going to continue to do that. So if you have an investor who is concerned about cash at the opportunity of investing in cash and the risks of the rest of a portfolio and thinks it's a valuable component of a portfolio, we do too. But holding it separately is not an efficient way to manage your investment portfolio. You're likely to get lower wealth over time if you do things that way. And what we will be able to do is, as the markets evolve and the situation evolves, to have the optimal allocation of cash that we'll be managing dynamically in a portfolio. So hopefully that will be able to give your clients a lot of reassurance of things are being thought through, things are being managed, and things are being managed right over time.